Hi again, and welcome to our next panel, Digital KYC, Onboarding and Authentication, the key to continuity. My name is Manesh Samtani. I'm the editor for Regulation Asia. So in the last few years, we've already seen a real push from the financial sector to digitalize access to financial services. And now the COVID-19 pandemic has really served to further accelerate some of these changes and really opened up, in some cases, opportunities for abuse by bad actors. So we're here today to talk about some of the advancements in technologies in the KYC onboarding space and how to address some of the potential risks of digitalization through authentication and other technologies or techniques. So I'd like to introduce our panel of experts. First off, we have Genevieve Noakes. Genevieve previously worked for Austrac, Australia's financial intelligence unit, as well as she's worked in several risk and compliance roles in wealth management before landing in the fintech world as head of AML at eNet International in Melbourne and London. Genevieve is now head of compliance for APAC at TransferWise. Welcome, Genevieve.
Hi, thank you for having me.
You're welcome. Thank you for being here. Also joining us is Bud CBE, the founder and CEO of iProov. So iProov provides award-winning and large-scale face-based authentication services to both private and public sector entities worldwide. So including the US Department of Homeland Security, the UK Home Office, ING, Rabobank, and the list goes on. Welcome, Andrew. Thank you for joining us.
Thank you, Manesh. Glad to be here.
And finally, we have Douglas Arner, the Kerry Holdings Professor in Law at the University of Hong Kong. Douglas specializes in economic and financial law, regulation, and development. He's written dozens of research papers on fintech and related themes. If you've read any of them, you'll certainly be stuck reading it to the end. Douglas is also an author, co-author, and editor of I believe 15 books. He served on Hong Kong's Financial Services Development Council. Thank you for joining us, Douglas.
Manesh, looking forward.
Thanks a lot. So before we kick off, just would like to remind the audience, submit any questions you have to us through the chat, and we'll try to answer them if we do have time towards the end. Douglas, I'd like to ask you to help us kick off the discussion, knowing that you're always up to date on the latest trends and developments in fintech, RegTech. If you could sort of give us maybe a debrief of the KYC onboarding landscape, maybe pre-pandemic initially, and then kind of maybe some of the key developments you've noticed in this space this year since the pandemic began.
Hey, Manesh, yeah, it's a sort of big topic there, but I think if we look at the space pre-pandemic, you can say that cooperation, international cooperation in the area of AML has been something that's been developing since the 1970s, something that we talk about as soft law, coordinated by an international organization called the FATF, the FATF, the Financial Action Task Force, and basically a system whereby most of the responsibility is focused on the financial industry in terms of know your client processes, suspicious transaction reporting, and the like. And I think over the past 10 years, it's been clear that this has emerged as a major expense for financial institutions. It's also emerged as a major challenge from the standpoint of financial inclusion, emerging markets. There was just a survey that came out yesterday saying that correspondent banking is down a further 20% since 2011. And it's something that pre-crisis, there was already a range of discussions, including a major UN report late last year, highlighting that the system didn't really work that well. Very expensive, not effective, but something that was taking up tremendous amounts of resources. And if we think of over the past decade or so, one of the most rapidly growing areas of compliance in the financial services industry has been AML and onboarding. As compliance divisions have come up with entire new teams on AML. 20 years ago, you wouldn't have an AML team in a compliance or a legal division in a financial institution. Today, in any sizable financial institution, you'll have your financial regulatory compliance, you'll have your sort of human resources, you'll have AML, and increasingly, you'll also have data, and that's just in compliance. in addition to what you may see on the legal side. And all of this has meant that this has been, and if we look back 10 years ago, very analog processes. Tech 10 years ago in onboarding was Google. Basically a Google search to see if you can find anything on anyone. And so much of RegTech, when we think about discussions about RegTech over the past 10 years, have been really focused. Many people think of RegTech as AML. And I think something that has been highlighted over the past 2 days is that's very much not the case, but it is certainly an area of focus. I think a couple of things have happened, particularly this year as a result of the pandemic. It's accelerated quite a lot of processes which were taking place prior to the pandemic. One of those was issues around the existing system, its effectiveness versus its negatives versus its expense. The second, however, very much the impact of technology. And I think what we've seen coming out of the pandemic is very much a dramatic increase in digitalization generally. I think this is well recognized. Second, we've seen a dramatic increase in digitization of finance, particularly in the context of payments. And the third is we are seeing an increasing effort as governments and central banks around the world try to deal with these technologies, these changes, in order to think about how can we put in place better systems. And so I think the big trend that we're seeing right now, directions towards coordinated interoperable payment systems, centralized, particularly sovereign systems of digital identification, often combined with golden source networked data structures in terms of information access for account opening. I think the last piece that I'll close before I hand it back is if we think about what was really holding a lot of this back before the crisis, a real nervousness in the industry in particular about the reaction of the regulators. And of course, I'm an academic. If we think of one thing if what I'm saying now, most people, including the regulators, would be nodding. 9 months ago, they wouldn't necessarily be nodding. They might be staring ahead straightforwardly, stony-faced, but it's a different environment. And one big reflection of that is a couple of papers that came out of the FATF earlier this year. One looking at basically the role of digital in AML, and a second one focusing in the context of digital identification. So if I could sort of pick up the big trends in the context of AML, COVID, and technology, it is, I think, an increasing big change in the way that governments and regulators are starting to think about the role of technology in the context of making systems that better achieve our overall objectives of reducing the criminal use of the banking system.
Thank you so much, Douglas. I see you nodding there in agreement. Andrew, do you have something to add?
Douglas has framed it perfectly. Look, what we saw was a gradual and steady move prior to COVID towards away from branch and in-person and mail towards remote digital onboarding, which is our particular sector, being done very cautiously, exactly as you said, Doug. The bank's a little bit worried about the regulators being very cautious about it. COVID has accelerated years of progress into a few months because suddenly all the usual processes have been made impossible. So we've seen, in some cases, a significant acceleration. Look, it was happening beforehand. One of our major customers was seeing 70% churn in their younger age group, specifically as a result of in-person transaction processes. And as soon as they moved towards onboarding, with the consent of what I would describe as an enlightened regulator, they eliminated that. So already there was a business impetus. We've seen different attitudes from regulators. And the response of banks to those different attitudes has been quite interesting.
I'm glad you brought that up, and Douglas had mentioned a bit of it earlier as well, just kind of about this push from regulators, including FATF, and there's other examples across APAC and elsewhere of regulators sort of pushing, perhaps not pushing, but encouraging the use of technology to facilitate access to financial services. Genevieve, what are your thoughts on this? Do you have any specific input?
Sure. I think the response from regulators has been mixed, and there's really some ways to go for quite a few regulators to fully embrace digital solutions. As Douglas mentioned, FATF has produced a paper on digital identity, and this paper recognises the tremendous growth of digital payments. I think it referenced 60% of payments volumes will be going through digital channels, companies like TransferWise. So in this way, we can see why perhaps correspondent banking is reducing its volumes. This growth in digital channels has necessitated a need for digital identity programs as well. MAS in Singapore, for example, has embraced this idea and enabled access to MyInfo so that customers' verification can be checked via an API to a central government database. For TransferWise, this has a very immediate impact. This kind of initiative has led to a 20% reduction in the cost of onboarding and a 30% reduction in contacts to our support centre from customers who need help to verify themselves. This is a win-win for us. In fact, the FATF paper says that digital identity technology is actually a better risk control than face-to-face verification. However, there's still some ways to go. For example, Bank Negara Malaysia is currently considering allowing business eKYC, and we fully support this initiative because eKYC is a stronger control, and it would allow Malaysian business to access financial services that would otherwise not be able to access due to pandemic and not being able to do those face-to-face verification methods. So I think digitalisation is not just an AML issue, it's actually an economic one, and there are still opportunities for regulators at the moment.
Yeah, so we also at Regulation Asia, we also highlighted that bit from FATF about sort of the introduction of these new technologies potentially lowering the actual risk. But I suppose it's prefaced on the assumption that you're actually that these processes you're undertaking are being done correctly. So speaking of that, I guess, it's a good opportunity to sort of talk about some of these potential new risks that the technology brings with it. I'd like to just run a quick poll question. If our listeners can just kind of hit that polls button on the top right hand. Just a very simple one. What do you think is the biggest risk to FIs when implementing new technologies for remote onboarding? Synthetic identities, money mules, deepfake attacks, identity theft. So let's just give the audience a bit of time to answer that. But meanwhile, I'd like to ask Andrew. I know you've helped a number of firms address a number of these risks with your technology. I wonder if you could just describe some of those risks and the challenges that financial firms are facing or trying to mitigate when it comes to adopting these sort of remote processes.
So look, when you're trying to onboard somebody in not just a compliant, but a way that is respectful of the objectives of AML, you have two fundamental problems. One is that you have to be able to accurately capture the attributes of the person remotely. Typically, that's by means of getting information from their identity card or their passport, and doing so in a way that convinces you that that information hasn't been altered or doctored is a real problem. And in fact, it's one of the principal problems. And there are two approaches which we're seeing in the world. One is to get a picture or a video of the document and use back-end databases to corroborate the information that you seem to have received. The other and much better way, a way that we're seeing regulators feel much more comfort with, is to use the contactless readers that are now ubiquitous on all mobile phones to read the biometric chip inside many documents, including the vast majority of passports, to get that information and pass it back. The great advantage of that is that you have a digital certificate attached to it, so that information has as much credibility as if you'd drawn it directly from a government database. The other challenge is to make sure that the online person who is making the application is actually real and genuinely present. That is something that has traditionally frightened organizations and frightened regulators, and has meant that in many places the highest levels of authentications had to be done in person. In reality, in some jurisdictions, online video calls had been permitted as an alternative to those. Those are now no longer ideal because it's quite clear that with deepfake technology, those cannot be trusted. So the key challenge to onboarding has been recognized by regulators and by banks as being assuring the genuine presence of the remote human being that the person asserting the identity actually is the genuine owner of that identity. And the ability to demonstrate that at a high level has in fact been a turning point for a number of regulators. The third point, which we've seen arising actually as a compliance necessity, is the ability to show that the solution is not just a pretty crystal frozen in time, but that the technology actually is backed up by business processes and people to ensure ongoing resilience, ongoing security, ongoing robustness against evolving threats. So just as you have to put these things, as we've heard earlier, in place for your back-end data flows, so you actually also have to show that they're in place for the capture of document information and the assurance of the genuine presence of the human face. Those risks are better perceived by than by banks, but COVID is rapidly changing that risk assessment. And thank goodness there are now technologies, including, but of course not limited to our own, that address that. Genevieve said quite rightly, I think that in many cases, I think that we're seeing a realization that technological solutions are actually better than in person. Some studies done in Australia showed that the skilled passport officers would mismatch imposters 10 to 15% of the time, whereas even average face matching systems will be 2 orders of magnitude better, 100 times better. So that, combined with strong genuine presence assurance and this reading of this document, the contactless reading of the document, actually ensures that all steps of the remote process are actually stronger than somebody turning up at a branch. And I think that realization is changing the market fundamentally.
Just quickly turning to the responses to the poll question. So the biggest risk for FIs when implementing technologies for remote onboarding, the biggest risk, 39% said identity theft, 28% said deepfake attacks, 26% synthetic identities, 7% money mules. So yeah, I don't know if you have any response to those answers, Andrew or Douglas.
I think that's 100%. That's absolutely right. Setting up accounts in the name of potentially real people or synthetic people who don't know or aren't complicit in that process is by far the easiest way to create these on-ramps. Look, I took part in a workshop held by the British government in Singapore last year on money laundering. Around some beers, in half an hour, we cooked up a scheme that would have worked really, really well. Contact me offline to get the details of it, and would have been almost undetectable. Its key was the ability to set up large numbers of accounts, tens of thousands of accounts, in the name of real but unwitting people whose identity attributes had been procured in a way that was quite clear was feasible, and who would pass AML checks by virtue of the fact that the attackers could convince the bank that the person was genuinely present online, and they weren't. That key, the ability to set up accounts in the name of large numbers, and its scale is really important in this case to spread the load out, in the name of either unwitting genuine people, therefore not money mules, or synthetic identities, I think is one of the key threats that is systemic at the moment.
Genevieve, how are you sort of dealing with these sort of potential threats at TransferWise? What sort of controls or security measures might you have to sort of mitigate these risks?
We tackle risks in 2 ways. I think quite important at TransferWise is our internal structure and the way that we set ourselves up internally. So we think about each part of our compliance as a product in and of itself. So KYC is a product, enhanced due diligence is a product, transaction monitoring is a product, fraud is a product. Each of these teams have dedicated product managers and engineers who only look at that sort of specific area. An alternative model here might be to have a large pool of engineers or product managers who sort of act as gatekeepers and who may prioritize work kind of differently. But for us, we're tech heavy, so we're able to organize ourselves in such a way as to have PMs and engineers who can be very close to the problems that they're trying to solve. Second, I think TransferWise tackles this problem through our mission. We're a mission-driven company. Our mission is money without borders, to be instant, convenient, transparent, and eventually free. And because this is our mission, our teams always question how we can do things in a smarter way, in a way that costs less or that is more convenient for our good customers, for example. And by combining our internal structure and our mission, it means that we remove impediments to meeting the aims of regulations, of AML and KYC regulations, because those product managers and engineers fully understand what their part of the product is trying to achieve. And added to this, we never stop developing our controls or security measures until we're instant, convenient, or eventually free. So this means we are constantly working to solve these problems. We're agile and we're fully resourced to tackle each component part. And I think this makes us quite powerful when we think about problems of security or control gaps. The question isn't so much how do we address regulatory issues, it's how do we structure ourselves to achieve the aims of regulation.
I don't know if Douglas, you might have something to add to that. I suppose the responsibility is not only on the financial institutions and the industry as a whole, but also governments and the infrastructure side. Any thoughts on that?
Definitely something that we're seeing from a number of different directions. And as I said, the sort of trend pre-pandemic, the history of the sort of AML structure had been very much where much of the responsibility in terms of investigation, reporting, et cetera, was placed on the industry. And if we look at the sort of technological horizons of the 1970s and the 1980s, when this system was developed, that was almost certainly the best way to do it. But the thing is, as I think we've all just highlighted, is that technological horizons have changed pretty dramatically and are changing really quite dramatically. And what that means is that there are definitely certain aspects where it's increasingly the case where it is really not the private sector that is best placed in some instances. One of those is very much in the standpoint of identity. You know, I think Andrew did a very good job in discussing the issues with a traditional paper-based physical form of identification. And I think we've seen an increasing range of jurisdictions, certainly with India as the paradigmatic example, using a range of biometric identification systems that simply provide much greater certainty that this individual is that individual. Prior to this year, there was a lot of uncertainty in terms of the financial industry around use of those, however. And I think the FATF guidance, which basically says that sovereign digital identification is at least as good as paper-based sovereign identification, is really the foundation of that. It basically says that going forward, a digital biometric ID should be treated at least the same as a paper-based ID, and it may in fact be the case that the digital is better. So one side is on the identity, and we can talk about not only from the standpoint of individuals, but also increasingly from the corporate standpoint, the use of a range of identifying systems such as legal entity identifiers that we're finding in particular in Europe embedded in a very wide range of different legislation, including probably forthcoming new systems looking at AML. So one side is on identification. The second is really from the standpoint of data aggregation. In other words, if we take that problem, and it's one that has been widely seen, where you have real individuals opening multiple accounts across multiple financial institutions in a very short period of time, no individual financial institution is well placed to pick that up. The only way that it gets easily picked up is if you have some sort of centralized system that actually places opening of accounts, or from the standpoint of identity checks. If you have a sovereign digital identity system and it finds that it's getting pinged from 15 different banks on a given day, it should be set up to trigger some sort of alert that this should raise some sort of question. And also from the standpoint of amalgamating data and using data analytics from the standpoint of the regulators, law enforcement, and the like, to aggregate information both from the private sector as well as from the public sector, in order to basically be in a position to better identify problems that go across multiple institutions.
Andrew, I'd like you to give you a chance to respond to Douglas. But also on top of that, I'd also like to hear a bit about some of the controls. I know you're a big proponent of the authentication technology. So I'd like to hear your thoughts on the controls that should be put in place. Go ahead, Andrew.
So I think the point Doug makes is 100% correct. What we're seeing, there's a problem of corroboration of identity attribute information. But then there's a really serious problem, which I think is underestimated by regulators, of binding that attribute information to the physical human being. How do you know, as I said in our previous case, that the person asserting that identity, which may be completely genuine, is actually there or not, or whether this has been in fact stolen? What we're seeing worldwide is governments starting to move towards making available their information sources, which are almost always the gold standard in information sources. The organizations that produce birth certificates, the organizations that produce national identity cards, the organizations that produce driving licenses, the organizations that produce passports, they have gold standards of information, which include photographs. And I want to emphasize the incredible importance of that. And they're starting to open that up. I think actually the leading example is Singapore, where we're seeing the development of the National Digital Identity Platform and its implementation through SingPass by banks and other organizations, which I think is actually a model that we will see copied worldwide, because I think it's going to be a huge success. In South Africa, for example, the Social Security Bureau allows lookup and checking of information. In the United Kingdom, you're starting to see lookup of identity attributes, but not the photograph. And the problem with the photograph is that either it's digitally coded as it is in a passport, or it's accessible online as it is in South Africa, or indirectly in Singapore, or you can't corroborate it. And it's very easy to stick somebody else's photograph on top of a paper or card document. And at that point, your whole AML regime is blown to pieces, because it becomes dead. The information on the card is genuine because it's been stolen from somebody on the metro an hour previously. Now you put a photograph of a synthetic person, doesn't have to be a real person, of a synthetic face. You put online, you put a synthetic deepfake, a moving deepfake of that same person. Bingo, you've just blown your controls away. So either you have to, so there has to be a collaboration, I think, to address this particular fault, the bind between the digital identity, which, as you say, FATF references, and the human being, because if you don't do that, your system is fundamentally broken. The best solution, and one that, for example, a lot of us are promoting adoption of in the United States on the back of Real ID, is to be able to do a real-time online lookup or a check of the face against the registered face, so that you know at least what your trusted reference face should be. Failing that, there has to be a dependence, I think, an increasing adoption of biometrically chipped documents which can't be subverted, and the European Union has introduced a directive which requires over the next few years all national identity cards within the European Union to be chipped. The third approach, as you say, is the creation of federated trusted identities, and the European Union has again a regulation called the EIDAS directive, which creates almost a parallel structure of state recognized electronic identities, which have very, very, very rigorous setup procedure requirements. But once you've got them, then you can use them. And the FATF document and a number of European regulations are a little bit unclear as to the degree to which EIDAS electronic identities may be used and relied upon in the banking sector. That's got to be the way to go, providing that the regulations for the creation of those electronic identities are robust. All you have to do in these systems is to put one weak point into it. That's where the criminals will punch through and subvert the rest of it. Historically, the weak point actually has been in the binding, not in the subversion of the information itself, but in the binding of the human being to it. I speak with passion on this because iProov is the world leader in solving that problem. So I would say that, wouldn't I?
I just want to follow on one thing that Andrew said, because it comes up over and over when we sort of start talking about these systems. Every time someone begins to talk about a system of sort of electronic KYC, there's automatically an assumption by many that what that must involve is a centralized collection of data in some place. And today, particularly after the Equifax experience a couple of years ago, centralized collections of data, honeypots, are almost never a good idea. So any system that is looking at centralized collection of vast amounts of disparate data is almost definitely a bad start. And that is something that for most people, when you're thinking about data, you're thinking that it's this aggregation. Increasingly, when we are looking at this, we're looking at federated systems where you are able to query systems of golden source data. In other words, you have different departments of different governments whose responsibility is to have different sources of data. You don't want to take all of that data and put it in one place. Rather, you need gateways where people can basically check. And as Andrew has said, get a yes or a no. Does this match or does it not match? And then be able to rely upon that in order to move forward.
Can forgive me if I just jump in briefly. There are these, exactly as you say, there are these three models, and I think it's important for regulators to understand. There's the centralized model, where you have one single source, and there are a lot of them. The National Digital Identity Platform in Singapore is one. Bank ID in Scandinavia is another. You know, it actually works very well, and it's the one that governments feel most comfortable with. The second model is federated, exactly as you say. This is beginning to work extremely well in the case of the eIDAS, which is a federated system involving many different identity issuers, all of whom are subject to a common regulation and who are networked together. In some cases, it doesn't work at all. So we've had huge problems in the United Kingdom trying to build a sort of a federated solution, and it hasn't worked very well, and the UK is trying again. But it is a very secure model. And the third model is so-called self-sovereign identity, where actually there is no database and you're carrying it around with you. In reality, that exists already. Your passport with its chip in it is a self-sovereign identity system because it's got a trusted database blown into the chip. There are various initiatives around the world, and I think probably the most comprehensively structured of it is actually the one being promoted by MasterCard. But at the moment, it's more an idea. There's more what I would describe as an ideological hope for the future success of self-sovereign identity schemes than actually anybody doing anything that they could seriously bring along to a bank or regulator and make stick for the moment. My bet, I think, would be on a combination. Actually, apart from MasterCard, which may very well succeed because of its vision and its scope, I think probably the balance is going to be between centralized, which governments really feel very comfortable with, and federated, which work if you've got a very good, strong regulatory structure binding it all together.
Thanks so much. I mean, this is all super interesting. We're nearly out of time, to be honest. It feels like only a few minutes have passed, but yeah, we could probably keep going. I want to just turn to Genevieve as a compliance sort of practitioner. What do you what does all of this mean for you moving forward in terms of the regulators as well? Do you feel regulators are sort of doing enough to promote these sort of digital approaches? What do you think the next steps are for the industry generally?
I think regulators could do more, but I would always say that. I mean, I think it's incumbent on the industry to engage with our regulators, share with them what you're doing to try and achieve that shared aim of creating an environment that's hostile to financial crime, and take them through the solutions that you've developed. So you really need to work with them to help demonstrate the solution that you might have, even if that looks a little bit different to what other people are doing. Maybe you have the three different models you've adopted that were just discussed by Doug and Andrew. Perhaps you have quite a robust refresh process that really considers customer behaviours intertwined with regular kind of biodata type checks. In terms of what regulators can do and policymakers, I think what they can do is create an environment that supports innovation in this area. And if we take Australia as an example, a very easy step in Australia would be to ratify the KYC reliance model. So by reliance, what I mean is allowing firms to rely on the KYC checks performed by other regulated financial institutions. This idea has been working well in the UK and Asia for many years, but in Australia, this bill has been sitting in Parliament for over a year. Now, if regulators want to have real impact in this space, the gold standard is to develop principles-based AML regulation that clearly articulates the risks that they are wanting to be managed and their expectations. And in doing so, I think they'll create a framework in which firms can develop innovative controls to achieve that shared aim I spoke about, to create an environment that's hostile to financial crime. And I think in doing so, you'll find markets with regulators who choose to do this, who choose principles-based regulation, become attractive fintech hubs and stimulate economies.
Manesh, can I back that up?
Yeah.
One of the things that we've seen in jurisdictions which are not principles-based, but which are very prescriptive, is you actually get a Mexican standoff. Sorry, you get a lock. You get a lock. That is, we go to the regulators. The regulators say, "We love your technology. We can see that this dramatically enhances the security of the environment. We can see that this is the way forward and will facilitate things. Get a bank. We can't move without a bank proposing it to us." So we go to the banks, and the banks say exactly the same thing. This solves a huge business problem. We've got to do this. These kinds of technologies have to be usable, and this is usable. This is a way we can see that this is going to get out of torturing our customers, which we haven't talked about at all with KYC and AML. This is great, but we can't propose it until the regulator allows us to go. So the banks won't go to the regulators because the regulators haven't given it the okay, and the regulators haven't given the okay because they can only respond to the banks. And this is a process that in some jurisdictions we've seen has gone on for years. So I think it's important that regulators clearly signal to their banking community, to their regulated community, that they have the mechanisms and are open to innovation, and that even if the regulations are currently very prescriptive, that they would welcome things that aren't prescribed if they represent positive innovations. That's a very clear message, which many regulators feel but aren't giving. The counterpart, interestingly enough, is that in principles-based jurisdictions, we're sometimes seeing an insufficiently clear signaling of the real risks that have to be addressed, which means that sometimes what we see in principles-based regimes is actually what I would describe as compliance theatre. The fact many banks in principles-based areas are using SMS as part of their strong customer authentication. And I used to run the world's largest SMS company, so this is something I know quite a lot about. When there are huge issues in the security of SMS. So principles-based regulators have to be clear, I think, about signaling the risks that they expect banks to address without prescribing how they should address them.
Thank you, Andrew. So we're pretty much out of time, but I want to give Douglas a chance to respond and maybe just give us some of your final thoughts before we end the session. Douglas, go ahead.
Yeah, and I think the key message is the technology is now to the point where we can build better systems of achieving our regulatory objectives. And I think that is the conversation that is increasingly starting to take place. And then I think it needs to take place going forward. And from the industry standpoint, you're talking to the regulators, don't talk about the costs or the inefficiencies. Who cares? What they want to hear is about systems that better achieve the regulatory objectives of protecting the integrity of the financial system, building trust and confidence, and keeping terrorists and criminals out of that. Take that approach, because that is what the regulators are tasked to do. And if you can give them tools which help them achieve their objectives better, they're much more likely to talk to you.
Douglas, I'm going to jump in because there's one more objective which you didn't mention, which is really important, which is accessibility and financial inclusion. You can meet all the objectives you just cited there in a way that, as I said earlier, tortures the customers in such a way that anybody aged over 60 stands no chance of accomplishing it at all. So I think inclusion, usability, accessibility should actually be a fundamental requirement of regulators to make sure that, look, you'll never reach 100% of the population. There will always be a proportion who can't do things, but without at least including that as an objective, I think that you risk solving and creating another
point. Because like one of the lessons of the pandemic has been in the context of government attempts to respond, it works best where you have the ability to get money rapidly to as broad a spectrum of the population as possible. And what that is financial inclusion, account opening, and electronic payments.
That's a perfect place to end, Douglas. And we're right at out of time. But I want to thank you all, Genevieve, Andrew, Douglas, for joining us on this panel. I'm sure we could have kept it going much longer. Thank you for joining us, and I hope to speak to you again soon.